In July 2026, China's quant funds lost over 20% in weeks. The surface story was a market-style shift. The real cause was factor crowding. We'll show how the most popular factors became self-defeating, using index-enhanced product data and the mechanics of synchronized selling. Quantitative funds are built on the promise of discipline and data. Yet in July 2026, many of China's largest quant managers saw drawdowns exceeding 20%. This is not a failure of a single model. It is a systemic event. When thousands of funds run similar strategies, they amplify each other's moves. The very sophistication that once produced alpha now produces synchronized risk. Consider the numbers. In the first half of the year, 1,236 index-enhanced products delivered an average excess return of just 3.11%. That is a collapse from 14.17% in the same period last year. Excess return is the extra performance a fund generates beyond its benchmark index. A drop of nearly 80% signals that the entire industry's edge has vanished. Where did the money go? In the second quarter, indices for storage and optical modules surged over 100%. Quant funds piled into these momentum winners. When everyone holds the same names, the trade becomes crowded. A crowded trade is one where many investors have taken the same position, so any exit is a stampede. The concentration was extreme. A massive share of systematic capital sat in a handful of sectors. Why does crowding destroy alpha? Think of the alpha pool as a finite resource. Alpha is the excess return generated by exploiting market mispricings. The total amount of mispricing is limited. When more funds compete for the same mispricing, each gets a smaller share. The formula is simple: your alpha equals the total pool divided by the number of active participants. The industry's assets under management ballooned from a few hundred billion to 2 trillion yuan. That is a several-fold increase in the number of people slicing the same pie. With more capital chasing the same mispricings, the average slice shrinks. This is the capacity constraint. Every strategy has a limit to how much capital it can deploy before returns diminish. The industry hit that limit. We can formalize crowding with a simple coefficient. Define the crowding coefficient C as the ratio of total capital in a factor to the available mispricing. When C is low, the factor is underutilized. When C exceeds 1, the factor is overcrowded. At that point, the expected return of the factor turns negative because the exit costs dominate. Here is the irony. The most crowded factor today is short-term reversal, which bets that stocks that fell recently will bounce back. This was once a contrarian, anti-human factor. But now everyone uses it. So when a stock drops, all these funds buy it simultaneously, creating a temporary bounce. Then they all sell at once, amplifying the drop. The contrarian factor has become the most conformist trade. The mechanism of the crash is a feedback loop. When an external shock hits, the momentum factor generates a sell signal. Because so many funds use the same signal, they all sell at once. The selling pushes prices down, which triggers more selling. This is a negative feedback loop, where the effect amplifies the cause. The result is a self-reinforcing downward spiral. To understand the risk, compare crowded and uncrowded factors. A crowded factor has high capital, low expected return, and high crash risk. An uncrowded factor has low capital, higher expected return, and lower crash risk. The problem is that crowded factors are often the most popular because they have worked recently. Investors chase performance, unknowingly increasing crowding. Regulators watch these dynamics. When systematic strategies dominate, market stability can be threatened. In response, authorities may impose position limits, increase margin requirements, or demand more disclosure. These measures aim to reduce crowding and prevent systemic risk. But regulation is a blunt instrument. It cannot solve the underlying problem, the finite nature of mispricing. The 2026 Quant drawdown is a textbook case of factor crowding. The industry grew too fast, the alpha pool was finite, and the most popular factors became self-defeating. For investors, the lesson is to diversify across factors and be wary of crowded trades. For quants, the lesson is to monitor crowding and manage capacity. The market will always have mispricings, but exploiting them requires understanding the crowd. We bring you data-driven insights into markets and finance. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.